Hello, welcome to the Economic View. Today we're going to be talking obviously about the federal budget released last night, special night every year, but this year in particular there were some major changes. So Evan, welcome to the show. Evan, our Chief Market Strategist. Evan, we were both here late last night,
we were
delving through the budget, trying to pick out all the details. There was many stuff to pick out, but what were your key takeouts?
Look, three things. So clearly the big one is the tax movements. They are staged over what they're calling their three-phase period. So I know you've done a huge article on it. Please have a good read. There's the short one. It happens in 18-19, which is up to $530 tax relief. So that's in those lower end tax brackets. 22 is when you'll see a movement of the tax bracket up to move bracket creep. So the 37,000 band moves to 40. You also see the 87,000 band, which moves to 90 in the first, will move to 120. And then the final phase, which from my perspective is a little bit tough to legislate, considering it's actually 7 years away, so it doesn't even fall into the projections, is to scrap the 37-cent tax bracket completely. So those between 41,000 and 200,000 earnings per year will see 32.5 cents in the dollar as your average tax bracket. Flattens it right out. So that's obviously the biggest one. Infrastructure spending is the next part, and I'm sure we'll talk about that on the economic front in regards to the $24.5 billion increase. Medical fund I found quite interesting as well. It's very small, but it is clearly a movement to try and actually grab international medical research. Was the next part of it, and then the super changes, and I think that's where we need to come to you next, is looking at that third stage, is the super changes that we saw last night and what they'll mean, also the retiree side.
Yeah, okay. So as we know, the last couple of years there's been changes on the superannuation front, including a couple of years back the government actually changed the parameters for the assets test, and that put a lot of people out of the pension. What they're doing this year, no surprises, it's an election budget, they're putting in some sweeteners. So in terms of the aged care sector and retiree sector in particular, let's tackle the superannuation retirement changes. There's been some additions there. So with the pension bonus scheme, which allows people to earn a certain amount of income above their actual pension, that's being increased to $300 per fortnight from the current levels, so by $50, which is a good thing, obviously. That's going to encourage people to work for longer, even while receiving the full age pension. Another scheme which they announced last night was the pension loan scheme. What that allows people to do is to release equity out of their home, and then they can essentially take money out of the government coffers for that, and then it's paid back out of your pension.
On that, which is quite interesting, something the government's been sort of advocating for a little while is how to actually sort of, as you said, take money out of the home, sort of leverage up on the average home and actually get that into it. It's an interesting movement. Again, it's certainly one that you've already started to hear politically, some movements against. I also wanted to sort of look at the big takeout yesterday, obviously, is what we've discussed as well over the last sort of 24 hours in our articles, and here is the return to surplus being ahead of expectations. It is wafer thin. So
yeah, just before we go down that track, sorry to interrupt, but just one more thing on super, which obviously for many of our readers won't be directly relevant, but the government's making some changes in terms of first getting the ATO to be more aggressive in tracking down lost superannuation, and this may affect you because if you've got multiple super accounts, you might have money sitting out there you're not aware of in an account. The ATO is now going to get far more aggressive in their data matching and repatriating that money. There's, believe it or not, there's more than $16 billion in lost super out there, and they're going to return that money into your active accounts. And one other thing for the younger people is that default insurance in superannuation on many of these industry accounts will move to an opt-in basis. So in other words, when a new account is set up, the person will opt in for insurance rather than have to opt out, and I think that's going to make a big difference. Sorry, Evan, back to you on
right.
the economy.
Yeah, look, the super changes are big, and for our readers, it is a big thing, and you do need to be fully over it, and there is a lot to cover there, so please have a read up on it. Look, from, as I said, the economic side and looking at what I do, returning to surplus sooner than forecasted. As I said, it's wafer thin, $2.2 billion. It's achievable. It does suggest that there can't be any form of shocks in the global economy particularly. I mean, if you look at why they're forecasting better surpluses, forecasting these tax changes, etc., is because the windfalls were huge. So the 2017 employment change has been a massive boon for the government's bottom line. The corporation repatriation's also done the same thing, and the reason for that, I've said before, spin-off of the post-GFC era tax losses, but also better than expected profits came in from MyEFO. So $2.2 billion in 2021, looking to go to about $11 billion in 21-22. So that's all well and good. Interesting thing around the infrastructure spending side, and this is where I sort of took most interest, is they're doing this 10-year, $75 billion plan, and this new $24.5 billion plan includes things like the Melbourne Rail, which was a $5 billion project, the Queensland Connects, which is a $1.3 billion project. Interestingly, a lot of it's coming from net debt. So there is going to be more raisings, although on the projections over the next 10 years, net debt is expected to fall because of the current economic climate. They are having to raise money to do this infrastructure spending. It is stimulatory. You can't go past that. There is no doubt. You've seen in the past these kind of projects add jobs, they add spending. They're a slow burn because of the years that they take to make. So they are sustaining. The question is, and I'm not trying to be pessimistic, this is a good, very low-key, very election-ish budget, but the pessimism is that debt is still being used as a way of raising. Yeah. So that's the only caveat I had is that, again, they're doing this through debt, therefore it doesn't appear in the budget per se, because it's also over a decade project, but it is a stimulatory effect, and fiscal policy needed to do that.
Yeah, I mean, that's what I like about it. It's going to create jobs, it's going to create spending in the economy, and that can only really be good over the long term. It's just a matter of, what we can bear as an economy.
Yeah, and just finally on that before we move off, interesting, the government is actually slightly less optimistic than the RBA on GDP. It's also slightly less optimistic on inflation, but it's more optimistic on employment. And that's the other thing about this, is they are very much believing that employment will pretty much continue to explode over the next sort of 4 years, and that is going to help the budget bottom line, and it's also going to mean, for their perspective, a higher political return.
Yeah. All right, Evan, we'll leave it there. Thanks very much for joining us on The Economic View.